Hi, everyone. I'm Ivan Buyuki, and welcome back to Wall Street Silver. Our guest today is the one and only commodities investing legend and the founder of Rule Investment Media, our good friend, Rick Rule. Rick, it's great to see you.
Pleasure to be with you, Ivan. Thank you for having me back.
Yeah, it's
Also,
always
former CEO of Sprott. That's you just introduced him as Rick Rule Media. He's got a little bit more title than that.
I know. Sorry
A
about
little
that,
bit more
Rick.
background.
Probably, if I may interject, more importantly, graffiti artist in Anacortes, Washington,
Okay.
putting Wall Street Silver graffiti around various lampposts in Anacortes, Washington to amuse myself.
All
Nice.
right. The prosecutor will be using this videotape in the trial, I am sure.
So, Rick, there's big news as of today, February 17th. We're seeing gold and it's breaking out above 1900. What's your opinion? Is this a breakout or a fake out?
I don't know, to be honest with you, and I have to say I don't care. I think it'll be important in that many people require price action to justify narrative, and there's been a lot of adoption of the gold narrative over the last 12 months. But there's also been a lot of how would you say it, impatience with regards to the chart action in precious metals. I think it's more likely than not that this price action stimulates people who were attracted to the narrative but disappointed by the price action over the last 12 months to come to believe and understand that the bull market is in fact intact. We talked in earlier interviews about the fact that the malaise that we've experienced over the last 12 months and the decline in gold and silver equities indexes is very consistent with market performance in past bull markets. And I think it's not unlikely that this does represent a breakout. But if it represents a fake out, I would argue that it's temporary, that cyclical declines in secular bull markets are normal and natural, and that paying attention to the factors behind the bull market are much more important.
There's also a recent, we're in a rate rising environment, and a lot of people have this intuitive sense that as rates are rising, that makes gold less attractive because no yield on gold. But Craig Hemke, our good friend over at TF Metals, he wrote a recent article on Sprott Money where he was well, here, let me show the title of the article if people want to find it. It's On Rates and Gold, and it's about a week or two old right now. But he demonstrated here that it shows here during previous rate rise increase cycles what happened with the underlying gold price. And this jives with what you've been talking about also, Rick. What's your take on that?
Well, I think it's important, and a shout out to Craig. He does a really good job of making complex topics simple, including with graphs like this. When you see a circumstance where gold is doing well in the face of increasing nominal interest rates, and in particular, when you see gold doing well during periods of nominal interest rates in US dollar terms, that, in my experience, has been a technical timing trigger for gold. More often than not, you will see the gold price decline in periods of US dollar strength or rising US dollar interest rates, which arguably leads to US dollar strength. A circumstance like you're seeing today and has been demonstrated in these charts means that you have gone through a period of time where gold has already performed well in currencies outside the US dollar, which have performed poorly in US dollar terms. And when then that market momentum extends to US dollar investors. In other words, when gold does well in US dollar terms, when the US dollar is increasing and when interest rates are increasing, in my experience, that's been a trigger point. If you look at this graph, what you'll see is gold consolidating for a while during a period of decent performance with rising interest rates. But when you see gold perform well in a period where there is strong US dollar performance too, the price rises that you see become much more dramatic. And it could very well be that that's the circumstance that we're headed into now.
Rick, you said in a recent video, trillions of dollars are invested in bonds where your loss is guaranteed even before credit quality. And in your opinion, why are people still getting bonds or going into bonds?
Well, I think people are making a mistake based on history, really. We've had 40 years of falling interest prices, which means we've had a 40-year-long bond bull market. But I think very, very, very strong negative real interest rates means that that bond bull market is over. Look at the arithmetic around, first of all, the US 10-year Treasury, the world's benchmark savings and investment instrument. The yield on that instrument has risen to 2% from 1%. But even with a 2% yield, that instrument in a period where CPI stated rate of inflation is at 6.5% means that the negative real yield is ugly. If you take the 2% yield and you subtract 6.5 from it, you see that
7.5, Rick. I'm sorry.
Okay, 7.5. Okay, yeah, 7.5. I was using a more conservative number because I can get away with it.
Okay.
You don't need to be dramatic at a time like this. If your purchasing power is being stolen at 5% compounded per year, the US 10-year Treasury, which is a wonderful proxy for bonds as a whole, is, as Jim Grant describes it, return-free risk.
Yeah.
If you want to be even more dramatic, the yield on the junk bond index is at 4.7. So if you assume that the US Treasury is a riskless security because they will pay you back because they can print, if you juxtapose the either 6.5% number or 7.5% number that you used in terms of the depreciation of the currency, and you understand that bond investors are accepting a 4.7% yield on a risky index. In other words, they're guaranteeing that they're losing purchasing power and they're taking credit risk. At the same time, what you're going to see is that subscribers to your show, people who for 40 years have been able to have some of their cash holdings, some of their more riskless holdings in savings deposits, certificates of deposit, that sort of thing, becoming increasingly unwilling to do so. If the bank is giving them 25 basis points and their purchasing power is depreciating at 6.5% a year, there will necessarily be some disintermediation out of savings products into other products that traditionally have yielded more safety relative to inflation. And I think, too, that when savers look at conventional private financial intermediaries like banks, and they understand that so much of the bank profit has to do with time spreads, that is, banks lending money for the 5 to 7 year time frame at fixed rates and funding that loan with overnight funds, very short-term rates, that works fine until it doesn't. But if you begin to have liquidity squeezes, or if the interest rate that's charged on very short-term deposit goes up, and you have a fixed rate long-term liability with a floating rate short-term funding source, you have a huge problem. And I think that increasingly even retail savers, but in particular institutional investors, need to look at the impact of inflation and negative real interest rates on traditional asset classes around debt. And I think that they're going to have to reorient their portfolios to reflect those concerns. And I think that can only be good for gold.
Yeah. You know, that's a good point you raised about it's been so long since we've had an inflationary environment. All of Wall Street, everyone managing any serious amount of money has never professionally worked in this type of environment before. It's been so long with low interest rates and, just bonds going down, bond yields going down, and, the asset, the inverse assets going up. You were CEO of Sprott. You deal with a lot of money managers, I'm sure, who worked for you. And you know exactly what that's like, right? You just have a whole generation that's having to relearn this environment.
I'll tell you a funny story about that, if I may. By the way, I was CEO of Sprott US, not Sprott itself. That's Peter Groskopf. It was odd. As the largest shareholder, he sort of reported to me, but as an employee, I reported to him, and it worked fine. By the way, I had occasion early on in marketing the Sprott physical gold and physical silver holdings to sovereign wealth funds and people like that worldwide. And I remember very well talking to a guy who was in effect a portfolio manager for an Asian sovereign wealth fund. And I remember he shared with me the various asset classes that they were invested in. They were overwhelmingly invested in US dollar denominated treasury securities. And I thanked him. I said, I'm a US citizen. And I love the fact that your country sends the United States all this cool stuff, cars, refrigerators, computers, heavy equipment. And we send you back pieces of paper with pictures of dead presidents. I mean, from my point of view, that's a hell of a trade, From your point of view, I'm curious. I mean, it feels to me as a US citizen that the US dollar is, on the face of it, sort of a lie. And that US treasuries are a lie printed on a lie. And I remember he looked at me and smiled. And he said, Mr. Rule, of course, ultimately you're right. But the lie you tell is a deep, liquid, and transparent lie. And the lie that other people tell us is a lower quality lie. There will come a time when we believe that we will need to reduce our reliance on US dollar denominated debt investments, but that time is not with us now. And I was thinking about that conversation, how strangely prophetic that was, when you are seeing now global disintermediation out of US treasuries into other asset classes, either because, like the Russians or the Chinese, they don't want to subject themselves to the extraterritorial grasp of the US government, or in the case of other countries, because the arithmetic being paid 200 basis points in a currency that's depreciating in value by 6.5% or 7.5% has become untenable.
Along with that conversation you had about the US currency being a lie, there was a very interesting video. This is Jon Stewart. He used to be the host of The Daily Show. And he got an interview with the Kansas City Fed president, Thomas Honig. Did you see this video?
No, but I've heard a lot of Honig comments before. Honig is, he's from the belly of the beast.
Well, I'm gonna play a quick clip from this video.
How much currency that has been sort of created out of thin air has been added into this economy through the Fed? What would you put as a figure? Would it be 6 trillion? Is that too much?
It would be, 6 trillion in terms of deposits with the banks and currency. Be 6 to 7 trillion.
Okay. That they're just injecting into it sort of out of nothing.
Out of nothing. They're the central bank of the United States. Now, think about it. It's just another form of government debt. Am I making sense?
It makes sense in the make-believe world of Conjuring. Like, there is a certain part of this that all feels like a mirage to some extent. Do you know what I mean? It all seems sort of fake.
Well, it's a fiduciary system. It's all faith-based, right?
Oh my Lord.
Yes, you got to have confidence in that currency, in that dollar, because there's nothing backing. There's no gold backing.
So it's in some ways it's a mass delusion.
Well,
so what do you think about that, Rick? That's pretty impressive.
Obviously, I guess because I agree with it rings true. What I think is particularly important is that the commentator, the person who said that, is from the belly of the beast. He's from the Kansas City Fed. Yeah. He's not some fat, balding, old libertarian named Rick Rule, but rather somebody from within the system. To have somebody who was part of a system that orchestrated the circumstance that we're in say that the circumstance that we're in is not reliable, I think is pretty important. I think it's interesting too that maybe it's a comment on mainstream media that some of the best commentators on the social circuit today are comedians. Maybe that says a lot about the world that we live in, or maybe it says that in terms of human nature, laughing is healthier than crying. But for many reasons, I would recommend that clip to your viewers, and thank you for showing it.
Thank you for giving us so much of your time. There's one thing I wanted to bring up here is you're doing something that I'm going to be attending. I know a ton of our audience is also interested in uranium. You're doing some sort of boot camp for people on uranium. Tell us about that.
I am, Jim. I've for a couple of years, graded people's natural resource portfolios, both to help educate them, but also to educate me. And I've graded between 7,000 and 8,000 portfolios that are oriented towards uranium. And I've learned an awful lot about how people invest and speculate in uranium. And suffice it to say, they do a poor job. And I've taken it upon myself to reach out to probably 100 people who submitted portfolios to me to determine how it was they acquired information and how they used that information to invest and speculate in uranium. And I was frankly horrified with the result. And that and the fact that I think it's now timely to invest in uranium again. You'll recall 2 years ago on your show, I said, get long. 6 months ago, 7 months ago, I said the uranium stock market is really, really, really overheated. Well, the truth is that the timeframes around uranium have been shortened. You'll recall too that I said it was inevitable, but maybe not imminent. The uranium market has been tightened up by the Sprott Physical Uranium Trust. It's been unbelievably successful, much more successful than I believed it would be, at the same time that the pace of Japanese restarts has accelerated. So where 2 years ago, I didn't know when the uranium market would turn up, now it's timely. And the fact that it's timely has coincided with the uranium equities declining by way of the index, at least by 50%. So now that the time problem has been satisfied, the market has obliged me by falling by half. So I'm beginning to allocate to uranium. I think the timing is perfect. But I think too that many investors don't have the benefit of 45 years of investing and speculating in uranium that I have. So I've designed an educational product that you see there, Rick Rule's Uranium Investors Bootcamp. This will be an 8-hour-long affair. Now, it's recorded, so you don't need to suffer through it all at once. And if you aren't available March 19th and you want to look at it on a delayed fashion, believe me, the curriculum will be timely enough that it won't be stale dated on March 20th. I've tried to do the best job I can to, within 8 hours, give somebody the fundamentals that they need to invest in uranium. So we'll talk about the politics of uranium. Spencer Abraham, former US Senator from the state of Michigan, and more importantly, former Energy Secretary, will talk about the worldwide and domestic politics of uranium. You'll hear the Chinese view of uranium from China General Nuclear, the parastatal Chinese company responsible for uranium mining and uranium fuel. You'll hear about the uranium market from Kazatomprom, the largest and lowest cost uranium producer in the world. You'll hear about the uranium market and corporate strategy from Cameco, the largest market cap company in the world. You will get an overview of the uranium market from WMC Consultants, the uranium and electric metals consultants that advised the Sprott board and put on the single best 1-hour presentation overview of the uranium market that I have ever seen. You will hear too from John Champaglia, CEO of the Sprott Physical Uranium Trust, and now I would argue probably the most important person in the spot market in the world. And you'll hear from uranium analysts and commentators and investors, people whose uranium experience wasn't gained in the last 2 years, but rather experience that was gained in the last 20 years. People who can put the supply-demand fundamentals of uranium in the context of a uranium bull market and a uranium equities bull market. I'm certain enough about the value that I'm offering that in this product, like every other educational product that I've offered for pay in the last 20 years, you have a full money-back guarantee. It'll cost you $99 to attend this symposium. And if you attend and you don't believe that you've got your money's worth, simply email me and said it wasn't worth it, and I'll give you a full refund. Now, I need to say, and
there's no better deal than that.
In 30 years of putting on, symposiums and conferences, I've always offered a money-back guarantee, and I've probably had to honor it 6 times. If your audience is honest, and mine always has been, and if you worry about the product content, the truth is that a money-back guarantee is riskless to me. But the fact that I'm confident enough means it's also riskless to the audience. I'll tell you too, that we have in the works another boot camp that you guys will find even more interesting. After the uranium boot camp, we're going to do a silver boot camp.
Oh, nice.
All right, we'll be all over it.
As you know, I'm attracted to the silver business for many speculative reasons, and I've enjoyed the silver market going all the way back to my youth. And I'm looking forward to a silver bull market that will surprise people too.
Yeah. Well, on that note, Mr. Rick Rule, once again, you're one of our most popular guests. The audience loves you, and we thank you sincerely for your time. And let's talk again next month as things develop.
I look forward to it. And as always, your subscribers are welcome to get my opinions on their natural resource stocks, including their silver and uranium stocks. Go to ruleinvestmentmedia.com, list your natural resource stocks. As always, please no crypto, please no pot stocks, please no tech stocks. I'll rate those stocks 1 to 10, and I will, on a no obligations basis, comment on those companies where I think my comments might have value. In addition, this is a long pitch. Any of you who care what private placements investments I can get into now, I'll notify you of those for free.
Nice.
If you're an accredited investor and you care about the private placements that I invest in, simply on the rankings database in the question and comment section, say placements. I've learned that I can notify people of my placements because it's not a solicitation, because I don't get paid. I'm not soliciting. I'm just notifying. I have commercial freedom of speech, which amuses me greatly. Finally, one more announcement. Many people know that I'm celebrating retirement by starting another bank. Years ago, I backed the guys that started Everbank. We sold it to TIAA-CREF, and we think there's enough disutility in the US banking business that I'm starting a new bank that will feature prominently non-US dollar denominated deposits,
Nice.
precious metals denominated deposits, and special loan programs for precious metals holders. If you care about that bank, on the rankings application in the question and comment section, say bank. We hope to be up and running this summer. And as I say, it's a wonderful way to celebrate my retirement, starting a new bank.
All right. Well, thank you very much, Rick. And we
Always
will
a
talk to you
pleasure.
again. Talk to you again next month.
Thank you.